Hey, this is Stock Market Wizard and you can refer to me as the Wiz. In this video I am going to tell you the 3 stocks I am buying in November. But first, this video references an opinion and is for information purposes only. It is not investment advice. Seek a duly licensed professional for investment advice. Make sure to subscribe, and hit that post notifications bell for more stock market videos. I make them every day, and leave a like if you invest. Every day I give away $10. All you have to do is sign up for Cash App, subscribe, turn post notifications on, and comment below your Cash App username. Also, you can join my free stock marketing group in the description and comments below. Okay, let's get back to the video. The first stock I am buying in November is Broadcom Inc., symbol AVGO. It is an American-based company that designs, develops, and supplies a range of semiconductor devices worldwide for smartphones, data centers, factories and more. Broadcom is part of the technology sector, and more specifically, the semiconductor industry, that has had its ups and downs the past few years. So why am I bullish on Broadcom? There are many reasons to consider initiating a stake in AVGO. As mentioned earlier, Broadcom sells a diverse portfolio of semiconductor devices for smartphones, data centers, factories and more. Many of these products are high margin and demand for them is consistent and secure. It doesn't hurt that Broadcom is the largest player in the industry. As Broadcom is able to sell a plethora of high-margin products, and has backed away from being an aggressive deal maker, buying up smaller companies left and right, it is now poised to use its hefty free cash flow towards increasing an already generous dividend and further share repurchases. Currently, AVGO yields around 2.9%, and forecasts show this could increase to 4.6% in 2 years, based on the stock's current price. At its current share price, AVGO currently trades at a low 11 times earnings, and could rebound to its historical average of 13 times earnings. Given a generous dividend yield that will most likely increase, and a share price that is currently below the historical average, initiating a position in AVGO looks to be a relatively safe bet. Investors can collect a handsome dividend while they wait for the stock to return to its historical valuation. They are currently at a 23% dip from their 52-week high of $285.68. It's a great time to buy this stock at this price. Let's look at the stock metrics versus the industry average. Their PE ratio is 7.67. The PE ratio average is 15.41. Their forward PE ratio is 9.96. The forward PE ratio average is 12.98. Their PS ratio is 4.35. The PS ratio average is 33.94. Their PB ratio is 3.21. The PB ratio average is 1.96. Their DE ratio is 64.13. The DE ratio average is 17.07. These are overall great stock metrics. The second stock I am buying is Electronic Arts. A shift towards digital versions of video games is a reality for all video game companies in the industry. However, with the evolution of live services, Electronic Arts has the potential to become the Netflix of gaming. Currently EA has 2 subscription-based offerings, EA Access and Origin Access. Origin Access is considered to be EA's plan for developing a subscription-focused ecosystem, similar to what Netflix has done to the traditional media industry. A video game subscription service has inherent advantages over traditional media subscription services, especially when it comes to the cost of royalties. As EA owns the games that it streams, it allows for a much higher gross margin than Netflix can achieve. Another thing I love about Electronic Arts is that it is one of a small group of companies in this business in a position to turn a decent profit. As for the delay of Battlefield V, it's unfortunate, but should NT be a big deal. The postponement will only push its revenue back to a subsequent quarter. The latest earnings report hurts, but most investors realize next quarter will be better. The 1-month delay will be beneficial when all is said and done. The October release of Activision's Red Dead Redemption 2 and Black Ops IV could have diluted sales of Battlefield V, with some would-be buyers opting not to purchase one or more of those 3 titles after the hype fades. By waiting another month, the excitement surrounding Activision's games may have run its full course, setting the stage for a pre-holiday frenzy that puts Battlefield V in the spotlight all by itself. EA is at a 37% dip from their 52-week high of $151.26. Let's look at the stock metrics versus the industry average. Their PE ratio is 44.37. The PE ratio average is 33.99. Their forward PE ratio is 18.23. The forward PE ratio average is 30.86. Their PS ratio is 6.97. The PS ratio average is 6.44. Their PB ratio is 5.72. The PB ratio average is 7.31. Their DE ratio is 18.88. The DE ratio average is 30.62. These are overall great stock metrics compared to the average and is one more reason I am buying EA stock. The last stock I am buying is the United States Steel Corporation, symbol X. It is an American-based company that produces and sells flat-rolled and tubular steel products primarily in North America and Europe. In the steel industry, the biggest news story of the past year has been the threat of and the imposition of tariffs. The threat of tariffs has caused steel prices to improve, which enabled X to realize higher prices on the steel it sells. While there are risks associated with the tariffs, there is also a possibility that the tariffs imposed by the Trump administration could lead to an actual discussion between all steel exporting countries, and a solution is found regarding the dumping of foreign steel into the U.S. that has been a long-term complaint of the U.S. steel manufacturers. If dumping is eliminated, steel prices would remain firm for the long term. Another positive going forward is the ongoing asset revitalization plans currently being undertaken by X. The company is spending approximately $2 billion on its plants, which should improve its earnings and help it compete with the likes of Nucor and Steel Dynamics. If the tariffs would ever stop, then I would dump this stock right away. They are currently at a 47% dip from their 52-week high of $47.64. Let's look at the stock metrics versus the industry average. Their PE ratio is 11.48. The PE ratio average is 11.96. Their forward PE ratio is 5.14. The forward PE ratio average is 12.12. Their PS ratio is 0.40. The PS ratio average is 0.66. Their PB ratio is 1.45. The PB ratio average is 0.60. Their DE ratio is 70.60. The DE ratio average is 54.41. These are overall great stock metrics compared to the average and is one more reason I am buying stock in the United States Steel Corporation. Thanks for watching. You can join my free stock marketing group in the description and comments below. Make sure to follow me on Twitter at @StockWizard for instant stock analysis. Give this video a like. Subscribe, and click the bell to turn post notifications on. Check out some more of my videos.